Hi, this is the Keiser Report. I'm Max Keiser. Yeah, markets, finance, scandal. It's all happening right here. We're covering it around the world. Let's bring in Stacy Herbert. Stacy, talk to me about the recent scandals.
Max, this is a scandal that's been ongoing since 1999 and is making big headlines now. Brown's bottom is an enormous issue in the UK. Was this a bailout of the multinational bullion banks involving the New York Fed? So Gordon Brown sold 395 tons of the UK gold supply, which was almost half of their gold supply, or more than half of their gold supply, in 1999. Now, since he did this, because of the manner in which he sold the gold, that is, he publicly announced that he was going to sell this, and he sold this via 17 auctions, thus ensuring that Britain got the lowest price possible for their gold. He sold most of the gold between $256 and $296 an ounce, and as we all know, it's well over $1,000 an ounce now. Since he's done this, there have been all sorts of freedom of information requests, demands from the Tories to find out why Gordon Brown did this when he was Chancellor. It now turns out that a court in the UK has ordered Gordon Brown to release the information on these gold sales within the next 35 days, which would be before the next general election. And it cost by his sale, in the method of his sale, it cost the UK taxpayer £7 billion, which is twice as much as the ejection from the exchange rate mechanism in 1992.
Well, what I find fascinating about this is the mention of the London Bullion Association.
The London Bullion Market, yes.
Right. Now, they have been implicated in a number of times in gold suppression schemes by allowing for rampant naked short selling of gold to keep the price of gold cheap.
Well, that's correct. This is in the piece on Jesse's Cafe Americain, and he's talking about the former Bank of England governor, Eddie George, who was speaking about this incident, and he said that we looked into the abyss if the gold price rose further. A further rise would have taken down one or several trading houses. And now the allegations in Jesse's piece is that it was AIG and Rothschild. So therefore, at any price, at any cost, Eddie George says, the central banks had to quell the gold price, manage it. It was very difficult to get the gold price under control, but we have now succeeded. The U.S. Fed was very active in getting the gold price down, so was the UK.
Right. This predates the whole AIG scandal, obviously, by many years, and it shows that at the core of the global Ponzi scheme, the global pyramid scheme, before the Bernie Madoffs, before the Lehman Brothers, before the WorldCom, before the Enron, there was this gold suppression scheme in London, which is about keeping the price of gold cheap so that the paper Ponzi scheme looks good by comparison.
Yeah.
And now, with this investigation, perhaps they will allow gold to trade freely for the first time in decades. If it were to trade at its inflation-adjusted price, Stacy Herbert, we're talking about gold going to $2,400, $2,500 per ounce.
You know, it's called Brown's bottom, by the way, because the price of gold hit $256 an ounce. That was like a 5,000-year low. It was Gordon Brown drove the price down that low by announcing the sales in the way he did. Now, Shadow Chancellor George Osborne had this to say regarding this, the order for Gordon Brown to release this information. He said, Gordon Brown's decision to sell off our gold reserves at the bottom of the market cost the British taxpayer billions of pounds. It was one of the worst economic judgments ever made by a chancellor. The British public have a right to know what happened.
Yeah, they sure do, especially as we go into this election. It looks like Gordon Brown was complicit in another massive market rigging scandal involving London bullion dealers. The New York Fed, of course, became notorious under Tim Geithner when he was running the New York Fed before he went over to take over Treasury after Hank Paulson had to leave in a cloud of controversy.
We're not waiting for George Osborne to find out for the next election. We went out to the streets of Trafalgar Square and we found out what they thought about Brown's bottom.
Can I ask you a quick question? What do you think of Gordon Brown's bottom? Brown's bottom.
It's hot.
It's hot?
Let's go.
Well, in fact, we're talking about Brown's bottom, which is a famous price point in the price of gold.
Ah, right.
Are you familiar with that?
Yes.
He sold the gold at the lowest possible price for decades.
Yeah, I know he would. Because he's decimating the financial structure.
It's horrible. That price, $254, it's now trading at over 1,000. He's deprived Britain of a lot of good money there, billions of pounds.
Yeah, certainly is.
Wow.
And I'm not happy about it.
Well, the voice of the people, the Vox Populi.
Well, now speaking of Gordon Brown, he may have made the worst economic decision in UK history. But I have this picture here with his very good buddy, Bono. This is from September 2009 UN meeting. And Bono's in the news, too. Bono named the worst investor in America.
Oh, my God. Oh.
These two are... Okay, so Bono, the Irish rock star, is also, aside from being a front man for, various Save the World campaigns, he's also a private equity partner at Elevation Partners. And apparently they've been ranked one of the worst institutional funds of any size in the United States. They own 25% of Palm, the makers that are trying to compete with BlackBerry and iPhone and the likes of those for the phone market. He has a $460 million investment in a company that is now worth $675 million. So for that $460 million, he only owns 25% of Palm. Take a look at the chart, too. So this is the past year's chart of Palm, and it's down from over $18 down to, it hit below $4 just recently.
I'm so sick of these rock stars trying to be economists. I'm sick of Bono and Geldof parading around the world stage as if they know something about economics.
Well, one of the articles that writes about this Bono being the worst investor says that in the process, Elevation Partners has made an unprecedented string of disastrous investments, which even bad luck could not explain.
Look, it's not bad luck, okay? Bono agrees to keep his rock chic ethos relevant, to be a shill so that these professional hedge fund managers can dump toxic, risky junk into his fund. Okay? He's being used as a front man, not in the musical sense, but in the market manipulation scandal sense. And I'm sick of it. I'm sick of Bono pretending like he knows something about economics. He doesn't.
Okay, Max. Well, we've got another headline here. People in power make better liars, study shows. Apparently, they had to do a study about this. But this is Columbia Business School, and they did a study which found out that, lo and behold, if you have a big office and the accoutrements of power, you're more likely to lie without any sort of physiological effect. Whereas if you're presented as an underling and you have obviously an underling's role, you'll get very nervous and agitated if you're asked to lie in these experiments.
Well, yes, because you can lie with impunity.
Well, that's what the study finds.
That's why guys like Lloyd Blankfein at Goldman Sachs, the CEO, claims he's doing God's work. He has a God complex because whenever he lies, people just give him more money. So it's called moral hazard on Wall Street. He gets rewarded the more he lies, the more market manipulation and insider dealing that goes on Wall Street, the more money they make. They get rewarded for criminality.
Well, and imagine what it's going to be like going forward, because the global financial collapse has been caused by massive fraud. But nobody's going away except for all of the underlings who are now being attacked. And those are my headlines, which really relates to this this notion that those in power, the very powerful, lie better. So arrests made after major insider trading raid at mega hedge fund Moore Capital. This is a $15 billion hedge fund. It's run by one of the richest men in the world, Louis Bacon Moore. He is not involved. It is the head of just an equity execution trader named Julian Riffat, who was arrested. Some individuals at BNP Paribas and Deutsche Bank were also arrested. It's the largest insider trading arrest by the Financial Services Authority in the UK. Now I have another related headline to this small fry getting whacked by investigations by the authorities. Busted insider traders talked in code like Bud Fox and Wall Street. Blue Horseshoe, frequent flyer miles. So these two Russian guys who worked in the U.S. at banks, one at UBS and the other at Citigroup, Legg Mason, and also at Northern Trust over the 4 years under which these alleged insider trading transactions took place. Now, the amount that they are purported to have earned is $870,000. Now, these are the ones making big headlines, all these big arrests, and they're done in, like, the press is alerted. All the hundreds of police officers showed up to arrest these guys.
The baguettes are fresh. The strawberries are ripe. You know what I'm saying out there in hedge fund land.
Well, that could be your insider trading information that you have. But the point is that $870,000 brings out giant press releases, all sorts of show trials and stuff like that, when 800 trillion practically goes missing from the global economy. It's trillions of dollars goes missing. But where are the people stepping up to the plate? And I'll finally end on this. United States Attorney for the Southern District of New York said in a statement regarding the arrest of these two Russians in New York, he said, financial professionals are part of a privileged elite who should be setting an example, not breaking the law. Or perhaps he should have said, or singing at rock concerts.
Well, structurally, there needs to be a re-architecture of the entire global system, and that's the only way to stop the racketeering that's going on Wall Street in the City of London. Anyway, Stacy Herbert, thanks again for being on the Keiser Report.
Thank you, Max.
Don't go away. Much more. Stay tuned.
A country house standing on the village's outskirts, with tight security, and in which window lights are never turned on. What are these walls hiding? Revealing European secrets of the CIA on RT. Though so many years have passed, some former prisoners are still alive, as well as their torturers. Though so many years have passed, some are hoping to find their saviors. Others hate their executioners and are longing for justice. Though so many years have passed, the memory is still alive, as well as hope and hate.
All right, welcome back to the Keiser Report. It's time now to turn to my guest, Mark Shapiro, a senior correspondent for the Center for Investigative Reporting. His most recent article for Harper's Magazine is Conning the Climate, Inside the Carbon Trading Shell Game. Mark, welcome to the Keiser Report.
Thank you. Good to be here.
All right, Mark, lay out the basic findings of your piece for Harper's, Conning the Climate Inside the Carbon Trading Shell Game.
Basically, here's the deal. If the whole world has agreed that cap and trade is the way to deal with climate change, so which means basically, you have emission limits, and then companies that come over those emission limits can go buy offsets somewhere else on the market. On the international market, you've now got a huge market in what's called carbon, which is basically carbon offsets, promises to reduce carbon somewhere in the world. This is the fastest growing commodity on Earth right now. So I decided to have a look at, all right, well, if that's the case, if this is the way the world is going, let's have a look at what this commodity actually is. And actually what this commodity is a consequence of a sequence of measurements of promises of enterprises in different parts of the world to reduce their emissions. So my article deals with the reliability of those promises. How do you measure those promises? And when I actually looked deeper into this question, I found a lot of questions, really, about how reliable the measurement is of those promises to reduce emissions.
Right. So it sounds like we just came out of this, we're involved, I should say, in this massive derivatives problem where nobody seems to know what the value is of anything. It's just made up on the back of an envelope and exchanged between bankers completely in a non-transparent way. So this is just an extension of the more kind of derivatives nonsense we're seeing already?
Well, you've got something there, actually. I mean, if you look at basically derivatives, were these bundles of products, of mortgage products, of wildly varying value. And now we've learned, actually, even the very way that they were valued was highly questionable, that there were clear links between some of the ratings agencies that give value to those commodities and the underlying derivatives themselves. So what we have now in the carbon market is some sneaky kind of parallels to that universe. And one is certainly the fact that the people who are paid to determine that they're the equivalent of in derivatives, you've got the ratings agencies. In the carbon business, you've got these bodies called validators. And the validators are literally a body of about a dozen companies that have been certified by the United Nations and by other certifying bodies to basically certify that the measurements of that the measured promises to reduce emissions in the future are correct. Well, those same rating agencies basically are paid for by the project developers. So there's an inherent conflict of interest in how the rating agencies of carbon work that is similar to actually the way the rating agencies and derivatives works. At the same time, you have actually what's interesting is I think a carbon commodity. So you've got a very lively secondary market now.
Yeah, of course. And how big is this market? Before we get into the secondary market, how big is the primary market?
The primary market is, at this point, somewhere between $150 and $200 billion.
Okay, $150 to $200 billion is the primary carbon market, and this is tied to the offsets that are issued to be swapped on the market in a way to incentivize, theoretically, people to reduce their carbons so that their value of these credits or offsets rise. But now, if you get into the secondary market, in other words, so there's going to be trading that's based on the primary market, and how big could the secondary market become? Is it going to be like the mortgage market, where the underlying market might be worth $500 billion, and then the derivatives market's worth 30 or 40 trillion?
None other than the World Bank tells us that essentially approximately 20 to 25, somewhere between 20 and 30% of the market for carbon involves the secondary market. That's a lot of money. We're talking basically in the area of somewhere around $50 billion, with a conservative estimate. And those commodities are being traded based on a bundle of, these are literally traded in 1 million ton bundles. So you're trading in London, you're trading in carbon, you're going to be essentially buying and selling 1 million tons of promised offsets. So these bundles contain various promises for emission reductions of highly variable quality. And so in that sense, there is a corollary to the derivatives, the housing derivative market, in the sense that the value of the underlying product has a very high level of variation.
Well, in the history of this bubble economics on Wall Street is, okay, you're saying initially the secondary market is 25% of the primary market. But we know that as Wall Street engineers more products, the credit default swap or the synthetic credit default swap equivalent, and carry it over to the carbon market, the secondary market's going to quickly equal the primary and then start to exceed the primary market. Because the incentive here, we know, is not to reduce carbon. The incentive is to create a new bubble. A new bubble because the real estate market collapsed, the dot-com market collapsed, long-term capital management collapsed, the savings and loan collapsed. They need a new bubble. And this carbon trading seems like a natural inheritor of this bubble economics thinking. So isn't the primary incentive for this to create a new Wall Street bubble to give Goldman and JP Morgan their Christmas bonuses next Christmas?
Well, it depends who you're talking to in terms of its primary motive. I think that it's no accident that actually some of the more forceful advocates of a cap and trade system have been the big financial houses.
Okay, who are the biggest players in this right now?
Yeah. You got Goldman Sachs, you got Merrill Lynch, you got Citibank, Bank of America. They've all got very large carbon desks in London.
Okay, so why should we assume that their motives are pure? Because they've got 1 foot in the camp of financial terrorism. You've got the Congress bringing back Dick Fuld from Lehman Brothers to question him about massive accounting fraud. Why should we assume? Why should the expectation be that these guys are involved in anything other than a massive new Ponzi scheme?
Well, I'm not disagreeing with you. Let's remember why we have this system. We have this system now because back 10, 12 years ago when the first international agreement around climate change was being debated, much of the world, including the European Union, where you're based, of course, and the other developed countries were arguing in favor of carbon tax, which many people think would be far more efficient economically to send a signal around reducing carbon emissions. Well, the United States came in and said, no way we're going to do a carbon tax. You guys are out of your mind. We want to do this cap and trade system to use the market to sort of channel money into anti-greenhouse gas technology. So basically the United States won that argument. That was 1997. And then basically what happens is, of course, 4 years later, President Bush walks in the door, turns his back on the Kyoto Protocol, says we're out of this whole thing, and essentially leaves the rest of the world to execute a system that was designed by the United States. And that is essentially what they've done. So while the United States has not been party to any emission limits whatsoever, our financial firms have been extremely active in this new global marketplace. And they've done it, of course, through London, which is, of course, the center of this global trade. I think one of the motives, obviously, for the financial firms is the huge financial benefit from this enterprise. I'm not sure I would ascribe that motive to all the other people who have an interest in cap and trade, who seem to think that it could work and to reduce emissions. And my reporting in Harper's was aimed at actually analyzing the emission reduction part of it and say, does this really work?
No, yeah, of course. In the 1970s, it worked using acid rain. In theory, it works. Capitalism works, and economics works, and Adam Smith's concepts work. But we live in a world of rigged market capitalists. And, as far as taxes go, once this bubble explodes and the Fed floods the globe with another $15 trillion in bailout money, that's just going to cause more inflation, which is just another form of taxation. So they're going to tax people one way or another. They just think it's more palliative to tax them using this under the rubric of doing something good for the environment, when it's just basically greenwashing another Ponzi scheme by the terrorists on Wall Street.
I think when actually you see the legislation that's U.S. and also the way the European system works, I think there are not enough checks actually worked into the system to ensure that the manipulation of the market and the potential collapse of the market doesn't happen.
There used to be checks. There used to be checks, but they were removed. That's what all the banks do when they make money, gaming the system. They use the money to buy politicians to remove the checks, and therefore you end up with a rigged market capitalist system. Now, many argue that Goldman Sachs sets the price of oil via the futures market. In other words, they manipulate the NYMEX in New York and other futures contracts to set the price of oil through market manipulation. I happen to be in that camp myself. Now, they control the price of carbon as well, right? They're going to be the axe, so to use the Wall Street lingo, in terms of establishing the price per ton of carbon. Is that true?
I think it's a combination of on the one hand, the major players, the major traders, and on the other hand, the government. So let's not forget that actually it's government that basically creates the market. This is a totally invented market. So the market is whereas normally, for example, if you've got a commodity, even like oil or God knows, even a mortgage derivative, you actually have a commodity that you could actually hold in your hand, put in your pocket, actually ultimately be delivered. If you were to invest in pork bellies or silver or whatever it is, you've actually got a commodity that's ultimately delivered to you. With carbon, you have nothing that's ultimately delivered. You basically get a certificate of paper which says that you've promised to reduce emissions by X amount, and we're going to send you a little certificate to that extent, demonstrating that.
Well, the commodity that's being traded here is clean air. That's the thing that people are trading effectively, and as the availability of clean air diminishes due to the industrialization around the world, this becomes a more valuable commodity, as does clean water and arable land, etc. Now, the number 3 player in this game, I think, is Cantor Fitzgerald, right?
Oh, yeah. Yeah, they're one of the major players.
How much did they spend lobbying the Commodities Futures Trading Commission to get approval for these contracts, do you think?
Well, they are busy lobbying the Congress because as you know...
But it falls under the purview of the CFTC, right? These are CFTC-regulated products.
That's still being decided in the United States, whether it will fall under the CFTC or the SEC. It's still very much in play.
Okay, because Cantor, spent more than $20 million lobbying the CFTC to get box office futures contracts approved.
Aha. Well, they are all over this bill, which is, there's a number of bills in the U.S. Congress now, and of course, some of the major lobbying forces are the financial.
Right, and Gary Gensler, who runs the CFTC, of course, is a former Goldman Sachs guy. And to get back to your comment from previously, you're differentiating between Goldman Sachs and the government. Is that correct? You're considering those two different entities?
Well, yes. I prefer to think that they are distinct entities, although obviously at various points they have a very deep community of interest.
You mean conflict of interest?
Well. Depends. We're at conflict with what?
The conflict between democracy and an oligarchy. That's the conflict, and they obviously support the latter. As we've been talking about on the show for weeks. Anyway, we're running out of time here. A very illuminating look into this carbon trading market, and your piece is called "Conning the Climate: Inside the Carbon Trading Shell Game." It's in. Is it in this edition of Harper's or the next one?
It was in. It's in the February edition. That people can go to my website, centerforinvestigativereporting.org, and get all the background information on this story too.
All right, Mark. Thanks so much for being on the Keiser Report.
Thank you. Great talking to you.
All right. I want to thank my guests, Stacy Herbert and Mark Shapiro. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.